Hey everyone, welcome back. I'm absolutely thrilled you're here today because we're diving into a massive, massive macroeconomic shift. You know that classic 60-40 portfolio, 60% stocks, 40% bonds? For half a century, it's been the reliable minivan of investing, right? You set it, you forget it, it gets you through almost any economic weather. Well, looking at the hard data today, I've got to be honest with you. That traditional 60-40 architecture is fundamentally breaking down. It's no longer a safety net. Honestly, it's starting to look a lot more like a tether to a sinking ship. Let's get right into it. Okay, let's dive into this. Check out this number. As of April 2026, the U.S. national debt just officially eclipsed a staggering $39.1 trillion. Trillion, with a T. That means the debt is now physically larger than the entire American economy itself. And look, this isn't just some abstract talking point for cable news. This parabolic debt level is the actual driver of a totally new macroeconomic paradigm. It completely rewrites the rules for how you need to invest moving forward. Right now, U.S. debt sits at about 137% of GDP. But here's where the rubber meets the road for your actual wallet. Since 2020, we've seen a 23% loss in the purchasing power of the U.S. dollar. That's a massive hit. It's basically the silent tax of high sovereign debt. So when you're feeling the pinch at the grocery store or the gas pump, yeah, you're feeling the direct result of government borrowing on a massive scale. That parabolic curve directly eviscerates your purchasing power. So how do we actually navigate this sinking ship? Well, here's our roadmap for this explainer. First, we'll cover the sinking 60-40 portfolio. Second, the rise of fiscal dominance. Third, the shadow mechanics of YCC. Fourth, institutional friction. Fifth, the real return trap and tips. And finally, number 6, the debasement trade. All right, let's jump straight into part 1, the sinking 60-40 portfolio and its structural collapse. To really understand why your traditional bonds are suddenly failing to protect your stock portfolio, you just have to look at this one number, $1.059 trillion. That is the annual net interest expense on the national debt right now. I mean, think about that. When interest costs blow past $1 trillion a year, the government is essentially caught in an inescapable mathematical debt trap. They literally have to borrow massive amounts of new money simply to pay the interest on their old money. There's just no escaping the math here, which means it is absolutely time to trade in that reliable minivan. Moving on to Section 2, the rise of fiscal dominance and our new macroeconomic paradigm. So, what exactly is fiscal dominance? It sounds pretty heavy, right? Well, it happens when rising fiscal pressures essentially force a central bank to maintain accommodative policy, meaning they keep interest rates artificially low and money super easy to borrow, regardless of inflation, just to prevent the government from defaulting. To put it simply, the central bank completely loses its independence. Fighting inflation takes a back seat to keeping the government solvent. And this creates a really vicious fiscal feedback loop. Traditionally, right, if inflation gets a little too hot, a central bank just hikes interest rates to cool things down. Pretty standard. But under fiscal dominance, that actually backfires. Just look at the progression here. Step 1, the Fed raises rates to fight inflation. Okay, but step 2, because the national debt is already so massive, the government's interest expense absolutely explodes into the trillions. Which leads to step 3, that massive interest bill causes the national deficit to grow even larger. And finally, step 4, the government has to issue more debt to cover that shortfall, forcing the central bank to print more money to buy the debt, which, you guessed it, fuels even more inflation. It's this wild paradox where traditional interest rate hikes actually neutralize themselves. Okay, Section 3, the shadow mechanics of yield curve control. Now, we've actually seen this exact playbook before, way back during World War II. To finance a ton of war debt, the Federal Reserve rolled out what's called yield curve control, or YCC. In 1942, they literally stepped in and forcefully capped T-bill yields at just 0.375%. They became the ultimate buyer of last resort, basically printing money to buy whatever bonds were needed to keep the government's borrowing costs artificially low. But there's a severe, unavoidable consequence to pegging bond yields like that. Because they had to print so much money to maintain the peg, by 1947, inflation hit 17%. And by 1951, it topped 20%. Today, we're actually seeing similar shadow mechanics reemerge through Treasury buyback operations. They are quietly suppressing yields and, frankly, risking the exact same inflationary outcome for our generation. Let's turn to Section 4, institutional friction, and the war for the Fed. We all know central bank independence is absolutely key to monetary stability. But right now, that independence is facing some unprecedented political friction. Between 2025 and 2026, tension escalated dramatically between the executive branch and the Fed. We even saw the Justice Department threaten an indictment against Fed Chair Jerome Powell over a $2.5 billion renovation of the Eccles building. This friction has essentially created this bizarre two-popes scenario. We've got a sitting chair nominated by President Trump, Kevin Warsh, trying to navigate a board that still includes the defiant former chair, Jerome Powell. Just looking at this objectively, for the markets, this internal division makes navigating our current fiscal reality incredibly complex. What we're seeing here is two completely competing monetary frameworks colliding. The Powell era was historically very data-dependent and reactive, right? Heavily relying on interest rate guidance to keep the markets calm. Conversely, the Warsh era is shifting to be much more trend-dependent, proactive, and heavily focused on balance sheet reduction. Because of the structural uncertainty and the perceived loss of total independence, bond markets are stepping up and demanding an independence tax. That is exactly why the 10-year Treasury yield has been stubbornly hanging around 4.292%. Investors are actively saying, hey, I need higher yields to compensate for this political risk and institutional freshen. Which brings us to Section 5, the real return trap and tips. So here is the brutal truth of the situation. High debt equals persistent 3 to 4% inflation. 90% of investors think that a massive national debt means we're going to see an immediate overnight market crash. But honestly, that's an illusion. The actual danger? It's a slow bleed. It's a persistent, slightly elevated inflation rate acting like the classic boiling frog scenario. It quietly, but relentlessly, eats away at your wealth over a decade without ever ringing the dramatic alarm bells of a sudden crash. Let's put that into perspective. Say you hold a traditional nominal bond yielding 4.40%. Sounds okay, right? But if inflation is running at 3.5%, your real return is almost zero. And hey, once you factor in capital gains taxes on that nominal yield, you actually have a negative real return. You are quite literally losing purchasing power safely. This is exactly why TIPS, Treasury Inflation-Protected Securities, are your new fixed income safety net. See, unlike nominal bonds, TIPS currently offer a 1.92% real yield, plus their principal mechanically adjusts upward with inflation. In a world of fiscal dominance, swapping traditional bonds for TIPS ensures you're actually getting real fixed income that protects your purchasing power and shields you from that slow bleed. And finally, Section 6, the debasement trade and fiscal hedges. If you want to know what to do next, just watch what the smartest money in the world is doing. The very central banks that literally print fiat currency, they're actively offloading U.S. treasuries and shifting heavily into hard assets. They are accumulating physical gold at the fastest pace we've seen since the 1950s. Think about that for a second. When the massive institutions that actually control the money supply start hoarding counterparty-free hard assets instead of their own paper, well, we as investors really need to sit up and pay very close attention to that signal. So if you're hedging against currency debasement, you basically have two primary vehicles. First, gold. It serves as your historical defensive anchor. It's got a finite physical supply and a strong negative correlation to the US dollar, acting as a brilliant store of value when fiat falters. Then we have Bitcoin, which acts as a digital commodity for growth. It has a mathematically fixed supply, but unlike gold, its correlation to the dollar is pretty close to zero. It acts a lot more like a high-growth technology asset that rallies with risk appetite. Both are fantastic bets against fiat debasement, but they play distinctly different roles in your portfolio. That non-perfect correlation is exactly the kind of diversification you need. Meanwhile, the US dollar, well, it has an unlimited supply. And when you're caught in a debt trap, that supply is mathematically forced to go in only one direction, up. So in this era of fiscal dominance, the traditional definition of risk has just been completely flipped upside down. A government bond is simply no longer risk-free if the currency it pays you in is being structurally devalued by the very same entity issuing the bond. Let that sink in. The only true risk-free asset is one the government cannot print. Which really leaves us with one final absolutely critical question for you to consider today. In a world sitting on a staggering $39.1 trillion in U.S. debt, where inflation is basically a feature, not a bug, what is anchoring your portfolio? Are you still blindly driving that reliable 60/40 minivan right into a storm, or are you adapting to this new reality of hard assets and real yields? Take some time to think about it, look closely at your own allocations, and as always, stay curious. Thanks so much for joining me on this explainer, and I'll catch you next time.